PNB Housing Finance, which reported a very strong quarter in March with a 50% growth coming in on assets under management. Also, the bottom line witnessed a 45% sort of a jump this time around. So what are the other key highlights of the quarter gone by? Let's ask the management. Joining us now is the Managing Director, Sanjaya Gupta. Good morning, sir, and thank you very much for joining us. For how long do you think can the company continue with this sort of a growth trajectory of 50+%? And again, what would give you that kind of confidence on growth in such a competitive environment?
The growth rates are all, an outcome of the capacities that we are building across the country and the economic drivers. So if the external macro economy improves, certainly our growth rates can be sustained. And I keep saying for this question every time that our growth is actually related to the capacities that we build and execute and put them to economic use in the subsequent year. So last year, which is 17-18, we have added 21 more branches across 8 new locations. We have added 3 more underwriting hubs. We have done a lot of advancement on our technology, which has further strengthened our target operating model. And I think we can easily do about 1.7 to 1.7 times the industry averages when it comes to growth rate. And we can sustain ourselves and keep on delivering very good quality customer service and good quality portfolio for years to come now. So it's a very robust and a stable organization that we have built.
So housing loans are about 69% of your lending portfolio and non-housing is about 30%. How do you expect this mix to change over the next 1 or 2 years?
Well, in the medium term, that is about 8 to 12 quarters, our strategies are not going to change. We are going to be very consistent. And at a portfolio level, pure home loans, that means individual home loans, are going to be about 60%. 12% is going to be construction finance for residential units. So together about 70% is going to be housing. In the non-housing segment, 15% will be loan against property, and the remaining 15% will be equally divided between lease rental discounting, corporate term loans, and non-residential premises loans. And we have delivered this sort of a mix over the last 6 years, and we are very confident we can do it in the medium term of, let's say, 8 to 10 quarters going forth.
Sure. Sir, but when it comes to the fourth quarter margins, they came in at 2.29% versus just 2.5% that you were able to do in the December ended quarter. Is this in any ways reflective of the pressure on yields, and what is the kind of range of spread that you would be comfortable with?
So the spread in quarter 3 was, I would say, an aberration, and that is why I had also given a little bit of a signal, because we did a huge amount of wholesale products in quarter 3. So what as a steady state one should expect is about 210 to 215 basis points of spread on the net interest margin or NIM. It will be around 305 basis points to 310 basis points. It is today at about 307 basis points. Our gross spread, which also includes our non-interest income or our fee income, will be around 340 bips. And our cost to income ratios are coming down now dramatically. Our OPEX to ATA is also coming down because the economies of scale are panning out. And I think that is the story on the profitability of this company is going to improve quarter on quarter, year on year from now onwards.
And with Tier 1 capital at 12.8% and fast capital consumption in FY18, when will you have to look at capital raising next?
Somewhere in the last quarter of calendar 2019 or the first quarter of 2020. Is what we are estimating that we will have to go back to the capital market to raise ordinary equity. Till that time we have, because just remember there are going to be internal accruals also. and they are going to smarten up as we go quarter on quarter and year on year. So I think by that time our net worth would be about 7,500 crores to about 8,000 crores, and we will be easily be able to lever about 10 times, and with that portfolio size we can go to the capital markets in that 6 months window from, let's say, October of 2019 till March of 2020.
Also, what on the cost efficiencies? Could the cost to income ratio tread lower further from the current levels?
Well, in the last year we did pretty well. Our cost to income ratio came down by almost 3 percentage points. We are, because you have to also time all these ratios to your go-to market or your, I would say, the next capital raise. I think in the next 8 quarters or 2.5 years, our cost to income ratios should come down further to about 16% or 17, and our OPEX to ATA should come down to about 56 to 60 bips, and hence our return on assets will grow from about 1.54 today we are sitting at to about 1.7, and we'll be levered at about 11 times, and we'll be making an ROE positive of 18%. Yes, it sounds very sort of easy, sort of an equation on a TV interview, but when you get down to working it, you have to really sweat it out to achieve these figures. But yes, those are my individual targets for the company.
So there have been various reports on your largest promoters, PNB, considering paring its stake, and even Carlyle having put a 10% stake on the block. Your thoughts on the prospects of a stake sale by some of these key shareholders?
You have put the toughest question at the end, and unfortunately, I mean, that's a shareholders' matter, and I cannot comment on it. We love our promoters, we love the other shareholders. We like them. We will like them to be there to enjoy this ride with us. But yes, if they have to, we can't do much about it. That's it.
Right. So you're saying that you haven't received any communication from either of them on their intention to sell stake?
As of now, I am not aware. I will be very frank. As of now, I am not aware.